that. All right, guys. So today we're going to talk about a carrier cheat sheet. Talk about this a lot in essence of saying, about 95% of your clientele can probably fit within these carrier restraints. The reason why I like them, I'll kind of explain as we go through, but I'm also going to tell you the ups, the positives, and the negatives for each of them so you can kind of use it at your discretion because there's no such thing as a bad carrier, right? Every carrier has their own product suite. And for me, if I've picked the right product, then I know I'm doing the right thing for the client. And I've joked with people in the past, and I've said this, and I mean it. Like from a compensation standpoint, some people will say, "Well, what pays the best?" And I say to them, "I'm like, every check cash is the same, so whatever's best for the client is the most suitable." But there are reasons why some people pick certain carriers. I'll explain that too as we go through this. But we'll just kind of dive in. Now, if anybody wants to book an appointment, appointments.valorfs.com. That's my appointment booking tool. Contracting, if you haven't gotten contracted with us yet, it's a microsite, so contracting.valorfs.com. It'll take you through and also get you on the newsletter. And then quotes.valorfs.com. So if you need help running quotes, these will be all the questions you need on a microsite, and it'll submit to me. It'll go to my email and then I can send it back to you. So it's just a simplified version to get things in your court quicker. So those are a couple little microsites and cheat sheets that you have already available. Now let's kind of dive in, and we'll talk about the selected carriers here. We'll give a little side-by-side comparison with some of the stuff like living benefits. We'll talk about some of like the non-med or automated underwriting, as I'd like to say. Comparatively speaking, different carriers offer different things, and we'll just kind of take a glance at everything. So first and foremost, or myself, Valor, I do appreciate more of the living benefit type companies. Reason being, much like anybody, is what they have the opportunity to provide with you don't have to die to use them, right? So everyone loves those strategies. Everyone loves the additional benefits, and it creates a better conversation with customers. Now, what I would say is obviously, coming from a prior company with living benefits, I don't want to say I play favorites, but I'll let you guys decide what you think makes the most sense. So if you look at Corebridge, for example's sake, and you look at National Life Group, pretty much the exact same living benefits. National Life Group will list out that they have like 7 or 8 living benefits. And the reason why they do that is because it looks cooler on paper. But you talk about Alzheimer's. Alzheimer's is covered in pretty much almost everybody's chronic illness definition. So when you think about Alzheimer's, for when people say, "Oh, well, they have a separate rider," well, guess what? You can get it with Corebridge, you can get it with Columbus, you can get it with Allianz. It's a qualifying event for a chronic illness rider. And and actually, I'll just backpedal for one sec. Chronic illness can't perform 2 out of 6 activities of daily living or cognitive impairments. Critical illness, heart attack, stroke, cancer, bypass, things like that. Terminal, you got 24 months to live. That's the idea with that. So, or 12 months, depending on state and depending on carrier. So those are the 3 living benefits. Pretty much every carrier has terminal. So I don't really call terminal a major living benefit. It's just kind of complementary. Yeah, Eric, you had a question?
Yeah. So on the core bridge, am I reading that underwriting risk class proper? Because I know with NLG, once you go Express Standard 1, Express Standard 2, they're cutting out living benefits. Is that accurate that I'm reading it that way, Phil?
You are reading it accurately. So that's that's the sizzle here, man. Like you look at the fact that you got 2 million, 2 million, 2 million, 1.5, 1.5, and then they strike them off at table D in standard for critical. All risk classes Doesn't matter if you're ready to run a marathon or you look like this, you're going to get all the living benefits as long as you qualify for the QOL product suite. Okay. Not selected term, QOL flex term. Not max accumulator, QOL max accumulator. So they're built in. They do cost a little bit more, say like a 5% margin higher. And but the value proposition again is what do you get with it? And so yeah, all risk classes, whereas you see all other carriers, you have a knockoff at some point, you're getting that situation here where it doesn't matter the risk class, you get approved, you get it. And that's huge.
That's
And
massive.
that's exactly. So now, and I'll tell you the pros and cons, Eric, you know as well, some of the time frames and things like that. It's pros and cons. How quick do you want to get the business done? But a lot of people, and I will stress this, the urgency to get stuff in, to get stuff out. Um, if I have a product for 20, 30, 40 years, will it take me a couple extra months to, not months, a couple extra weeks to get through underwriting? Possibly. But long-term vision versus short-term situation, that's where I'll say Corebridge, you're going to find, and I'll talk about in the next slide exactly why I said that. But Corebridge and National Life Group have pretty much the same designation and how they look at it. F&G for the most part too. The idea really is it's an acceleration of your death benefit. Some people call it like a life settlement option, where you pay a premium and excuse me, your death benefit says $1 million, and some type of claim hits, and then all of a sudden they give you a payout, let's say of about 400K. That would be a full payout or 100% acceleration. So the idea is that pending on the ailment or issue, they will do underwriting on the back end, see how it has impacted your life, and then from there they'll give you a cash payout. I don't like using this terminology or phrase that I'm about to use, but I will because it can make sense to those who do this. If anyone has ever played the lottery, show of hands, thumbs up, anything. The idea of the Powerball, right? You got a $500 million payout and you win. Congratulations. What's the first thing you do? Everyone always says, well, I'm going to take the lump sum, right? But the lump sum
Yeah.
is not,
No,
right?
I want that.
Yeah.
No, bad.
No. Bad. Well, what's the other option, Eric? What's the other option?
Well, you get paid out over the period of time, it reduces your taxable income every year, and usually will end up paying out more. Plus, anybody who receives $1 million and has never seen more than 100 grand, everybody knows they're going to blow through it. So, if you take lower payments, yeah, it looks like it's less, but it's actually more because taxes are going to eat it alive when you get paid $10 million in one shot.
Yep. But I will tell you this much, some people, because they see that number, it would take 240 million versus 500 million because it's actually in their bank account today. So the idea is if I got the today number, it's the same thing with these life insurance accelerations. So they basically will pay you out over a 30-year annuity. So 240 today would equal 500 million 30 years from now based on what they pay out. That's how they work. So the same thing with these, let's say I'm 44, something happens to me and my life expectancy goes from 80 to 65. Well, they're going to say, all right, well, Phil has $1 million policy and he's 44. What would it take for him to have $1 million if he invested today to hit 1 million by 65? And so they would give me the present value of my future death benefit if I took 100% acceleration. So some people will say, well, I got gypped. I just lost half my death benefit, but they don't realize you're getting your full death benefit just in current dollars, not in future dollars.
That makes sense.
Yep. So so that's where some people you can get higher numbers with these carriers with their living benefits. But on the flip side, some people like actual percentages like you would get with Columbus, right? Or you would get that with North American with percentages. Now, the argument that I would have is on the critical standpoint, I can only get on the UL up to 50K. Okay, that's the max. It's 25% or 50K, whichever is less. Okay. Now, if I had a critical illness, for example's sake, someone that I know had two forms of breast cancer, $1 million policy, gave them $400,000 in cash. That is a critical illness. They would have kept 950,000 in the policy and got a $50,000 sum of money as opposed to maybe using more. But if they like percentages, they don't want to leave anything to chance. North American has a better value proposition for that customer. And then you have Columbus, which actually uses a similar method, but you'll see 10% of the death benefit up to 25K. What they don't say on this sheet, but what I confirmed is it is your total cash value plus 10% of the death benefit or 25K. So I can actually calculate on a piece of paper with Columbus exactly how much I can get for a living benefit. So it just depends on your customer. And that really boils down to the questions that you ask them to see what makes most sense to them. If they had a critical illness, do they have backup assets? Is 50K enough? Do you think you want to accelerate a bigger amount if you need it? These are all questions that you can use to derive to the answer to get to where you need to be.
Oh,
So, from that standpoint, we'll kind of move to the next section, which is automated underwriting. Okay. So, automated underwriting, you'll see here that carriers have different types of automated underwriting classes. For example's sake, Corebridge has term in their GUL up to $1 million and their IUL up to $2 million. Now, with that, if, for example's sake, I wanted to do an IUL, I could do a $1 million IUL and $1 million term at the same time and get non-med. If I wanted to do $500,000 IUL and 1.5 million term, that's going full medical. Okay. You can't go over the maximum guidelines per the product. You can't do 2 million in IUL and 1 million in term at the same time because that's a total of 3 million on the line. And that would be exceeding 2 million max. Okay. Now, I will tell you right now, Corebridge preserves the sanctity of their pricing for their term. So they have probably about a 30 to 40% pass-through rate on term for non-med. Positive, I was literally on the phone with someone. I did a Zoom with a client who 25-year-old female, $1 million term, and she got it approved that night. So I was on the phone with her doing the tele interview, did the part B, not tele interview, online interview, did the part B, and actually got approved preferred best that night and got her policy placed the same night. So it is possible. They do not do it for foreign nationals, so it is U.S. Green card holders as well, and you can get that. IUL is more liberal. They're at about a 70% pass-through rate, or that's where they want to be for the IULs. But I will coach you guys and say this, and this is the most important thing about trying to do non-med with Corebridge. You have to be open and honest. It's not a find out or not find out and hope for the best. Because if you take blood pressure meds, say it because they do the back end with medicals. They will go through Milliman report, which most carriers use now is a Milliman report. And it looks at your hospitalizations. It looks at your doctor visits. It looks at if you sneezed wrong. It looks at all your medications. If you're on metformin, guess what? They're going to find out. So all those things are important. So if you don't admit it, you're going right to medical because if you're hiding that, you're hiding something else is what their theory is. F and G, true, non-medical. Okay, so you'll see all these programs, they say automated underwriting, accumulated underwriting, whatever you say, accelerated underwriting, excuse me. F&G is the true non-med carrier. A million or less, they only sell IULs, strictly or mostly focused on accumulation sales. You can go all the way down to a table four with them with true non-medical. Okay, so you have the opportunity with them to go through that. Again, we'll go through pros and cons as we get through to each carrier and some of their unique niches. Some people say niche. I used to say niche until my boys both said I say it wrong and ridiculed me. I'm now an inside joke for that, kids. Um, but but yeah, Columbus, they have a non-med up to a mil up to 55, permanent only, and I would say they're a little harder to get through from that standpoint. Allianz up to 3 mil, they only do IULs, so it's a one-stop shop for that. Pretty consistent, and we'll again go through some of their information as we go to theirs. National Life Group actually increased up to 5 million. Okay, so this is actually increased up to 18 to 50, up to 5 million. Okay, typically with their underwriting, they will produce more standard non-tobaccos and they will preferred or preferred bests. They do not care about the sanctity of their pricing for term. They look for speed to issue. Okay, so they're usually priced a little bit more costly, even apples to apples with, let's say, a Corebridge. Corebridge is cheaper, but you're probably gonna have to do more underwriting. Um, and so it just depends once again on your client, your process. So it just depends. Symetra Swift term has also moved up to 5 mil. So they have actually increased their line as well. Standard or better. I literally got someone approved in a day. $3 million, 50-year-old. So the Swift term is amazing. Their IUL. Also, they have a Swift Protector product, and they're working on doing a Swift accumulation and living benefits too. So we'll see more Symetra in the future in the living benefit space too. North American is pretty consistent as well from their non-med perspective. So a lot of great carriers. But let's kind of dive into the individuals.
Philip,
So
sorry, just a quick question.
yeah, what's up?
I see that John Hancock didn't even show up anywhere in this.
Because they're not a what I would consider core carrier. We have Hancock, don't get me wrong, but from the standpoint of they don't have living benefits, situational. So we have 40 carriers, and that's why I said in the beginning about 95% of them will kind of fall in line here. But when you talk about like a traditional brokerage kind of carrier, so Lincoln, Hancock, Prudential, they'll fall in that category. But when you talk about some things as well, the reason why these are great carriers is because if you want to do hierarchies and structure like you're building an agency, you can do sub-level hierarchies here where the carrier will pay the agent and you don't have to do LOA or anything like that. So true ownership, true opportunity, stuff like that. So that's why they're core carriers from that standpoint. But again, we have other carriers too. Um, with this, someone asked, where do we get access to this cheat sheet? I have it available too. So things like this, we have actually a link to the Corebridge microsite, which will probably pull up if I did it outside of the presentation mode. But some reasons why I like them, 18 different durations of term. Okay. So, Sridhar, did you have a question?
Like it's like a everyday type of thing. You know what I'm saying? Like
We'll just do that, do that, do that. All right, so 18 durations of term. So they have a 10, 15, all the way up to 30. Yeah, all the way up to 30 and 35-year term. The only carrier in the industry to have all of those durations. And, if you are comparing, say, someone had a 20-year term that they bought 3 years ago, If you use other carrier, you have to either sell a 15 or a 20-year term. So it might be cheaper, but you lose some years. Might be more costly, but you gain some years. Why don't you do a 17-year term and show the difference and see if you can do better? So, plus living benefits. So cost efficient premium, they're the cheapest when it comes to living benefit carriers, especially in the term chassis. So those are your living benefits, ABRs. Strong competitor, North American term. North American could be a little bit more liberal, especially with diabetics. But again, the pricing still leads QOL to be the number one. On the permanent side, the Value Plus Protector, and I shorten this, so just again, we focus on the QOL suite. So QOL Value Plus Protector is one of, if not the best, when it comes to life expectancy uh, protection-based IULs. So you'll see a lot of people online who are like, oh, IULs are bad because the guarantees, this and that. You can actually dial guarantees on the Value Plus. They go to roughly the mid 80s anyway. And folks, I'll tell you right now, us men, average age of mortality, 78 to 82. Women, 82 to 85. So when you think about that, if you have the life expectancy guarantees in the 0% column, more than likely you're going to get some type of returns. And by the way, they just added the NASDAQ to the Corebridge lineup. So you have the S&P and the NASDAQ for simplicity purposes, understanding the different types of indexes. You don't have to deal with all those crappy proprietary ones. But you can dial a guarantee, you can dial it to 100 if you want to. We can make it work, but it's one of the most cost-efficient products in the death benefit focused IUL space. And it also has a return of premium option, 50% at year 20 and 100% at year 25, depending on a couple restrictions, but for the most part, that's accurate. QOL Max Accum, strong for the accumulation side, 30 to 55 is their sweet spots. And I'll tell you right now, they have had some of the strongest rate integrity when it comes to their S&Ps. So I've managed and monitored cases that I've taken over as agent of record from 2018, still around 9 to 11%. It fluctuates, but it hasn't like dramatically dropped like some other carriers. And then again, they added the NASDAQ too for some stronger growth potential opportunities. The folks will tell you right now, this is one of the biggest sizzles to the steaks. Okay, so the QOL bonus. So if you sell in excess of 33,000 in a calendar year, everything above that will get a 20% bonus that will be paid out at the end of January of next year. So not only do you have strong products, a great value proposition, but you can also get a little extra kicker on top of what you already make in regards to a bonus that is uncapped. So we've had people sell and make 100,000 in bonus money. They've bought themselves a Tesla, they bought themselves a Porsche, and things like that. All while still having a great value proposition on the product. And if you're one of the top 72 and you sell in excess of 110,000 in a calendar year, you're on your way to a trip. So last year it was Utah, but I don't know anyone who wants to go to Utah, right, Caleb? Just kidding, just kidding. Utah's nice. Utah's nice. I did Vancouver the year before, and before that was Marco Island in South Florida. So a lot of great opportunities to reward you for the opportunity to just partner with a great carrier. Next up.
That refer to target premiums, correct?
It's target premium, weighted target premium. So if you do a 1035 exchange, 10% counts towards your bonus on anything above target. You don't get paid that 10% in excess. It's smaller, but from the standpoint of your bonus, it can tally up. So if you do a lot of 1035 business, you can see a lot of rewards on the bonus side. F&G. The only IUL carrier, or IUL only carrier, I should say. Again, microsite in the bottom left-hand corner. They are primarily a product for accumulation. That is their goal. Typically, if you ran these stock illustrations, I am not a stock illustration guy. I like S&P, S&P only or NASDAQ. They usually run their Barclays or they run, something different, and that usually puts them to the highest part of the food chain. But if you actually run it with the S&P, they drop to like sixth or seventh. And then Allianz does the same thing too, just a sneak peek. But if you ran it with what they want you to run it at, it'll show usually the highest income. Um, but on the flip side is they have usually the lowest target premiums in the industry. So it's a sacrifice you make for non-medical. Some people like it, some people don't. So it just really depends on the customer. It depends on your value proposition too. So they have true non-med up to age 60, up to a mil. They will do non-med up to 240K for H1Bs. No lab work required at all. They will do an APS if they need to, but they will not do lab work. Okay, unless you go above a million. So I don't really sell a lot of F&G. I'm just going to be honest. A lot of cap rate integrity concerns that I've seen from them. And for those who have been in the industry for a while, they kind of follow suit with a lot of what you've seen from Global Atlantic, who is completely out of the IUL industry now. Go ahead, Eric. What's your question?
Wondering, as far as like internal fees are concerned, which of the carriers are your preferential? I know Allianz has probably the lower, and Securian for sure, but they're not. I mean, Securian isn't a great for this conversation, but
Yeah.
Allianz I know has pretty low fees. North American is moderate, but out of all the ones that you've presented today, as far as fees are concerned and best cash accum, where would you lean?
With living benefits, Corebridge. Without living benefits, Symetra. So Symetra has one of the lowest cost IULs in the industry right now. I would say even lower than Allianz.
I did not know that.
So
Thank you.
yeah, no problem. And we'll talk about them too. So they're a great, great, great carrier. Um, so we have the microsite for F&G. Um, Again, not one of my top five, but for those who want to do quick and dirty, they are your quickest and your dirtiest. So I'll put it that way. Um, so Columbus. So Columbus is a hidden gem. For those who don't know, they are part of Western and Southern, based out of Cincinnati, Ohio, and they are extremely vanilla. Why is extremely vanilla good? When you think about it, from the standpoint of the product suite, do you want to have to explain all the gadgets and gizmos galore? I know I just did a Little Mermaid reference there. In case anyone didn't know, that's Little Mermaid. But they use just the S&P. The big perk about them is they use Inforce and their new business share the same cap rates. Okay, right around 10 or 11%. So if we look at how the index has gone, the S&P averages between 8 to 10% over the last 90 years. I think it is, or at least the last 30. What you have there is tried and true, simple and easy. So on paper, you're not going to see them boost up to the top of the charts. But what you have here is a carrier that if they're looking for accumulation and also death benefits, so kind of that mix between the two, they're a great carrier to look at. I'm not going to lie, their underwriting does take a little bit. But if you have the right product, again, you have the right fit, it makes the most sense. Where they differ from some of the other carriers, again, a little bit more of a realistic perspective. They don't play any illustration games, that's for sure. But they do a 12-year renewal schedule, not a 10-year, which is what you typically see with most carriers. So if you're getting paid renewals, the first year is the biggest, obviously, and then usually you get nine after that from the carrier. They give you 12 years. So cool. Here's where it can really add up. So, trail commissions on cash accumulation. One of the biggest problems we have in our industry is churning business, talking bad about a product, and then trying to push it to another one. Well, here you reap the benefits of actually continuing to promote and take care of your customer. Why? Because cash grows inside the policy. As cash grows inside of the policy, you get trails starting in year 2 and beyond that accumulate based off of the cash growth inside the policy. So it's almost like AUM, assets under management. You serve your client, he continues to grow. Now think about it. If you start selling a lot of policies of Columbus, that can stack. Okay. Again, a great carrier, very plain vanilla. We are doing a little event with Columbus in September. So there's limited seating there. If anyone is interested in going, you fly there, they'll take care of hotel and food. And but we can talk about that separately. One thing I really like about them is the table shave program. Okay. So table shave program is up to $1 million. You get 3 tables on their permanent policies. So they're IULs, they're GULs. You can take a table 3 and shave it to standard. I had a client who had some cardiac concerns, sleep apnea, and 8.0 A1C, standard non-tobacco. It's not going to happen all the time, so don't start sending all your worst cases to Columbus. But what I'm saying is that we have to just monitor, keep out a lookout for the type of clientele that you have, and reposition them to the right carriers that make the most sense. The cheapest price does not always win. It looks great on paper, but illustrations prove one thing: ink sticks to paper, and that's it. You have to look at the undercarriage of the product or the design. So great story with Columbus. Not a lot of people look at them. Underwriting is probably the slowest out of all the carriers that we're talking about today. And I'm just full transparency, okay? But they're still one of my favorite carriers to work with. Okay, next up, Allianz. Big elephant in the room for IULs. So if you'll notice here, I actually put it industry leader. Why? They have a really cool story with this rate lock, and most people sell it because of this. I say highest income, but as I mentioned before when we talked about F&G, if you do S&P only, you'll see Allianz go from 1 or 2 down to 6 or 7. The difference is that they focus more on their PIMCO and their blended strategies as opposed to looking at something from the standpoint of the S&P 500. So they have the highest targets. They're really focused on the accumulation sales. They at time to time will do rate class increases. I believe they have that right now. So if you get a standard, they're going to put you up to preferred best. Doesn't mean it's great for death benefit focused sales because their target and their guideline level premium are so close to each other that you can't underfund them. The objective is not there for that. The biggest thing that I don't like about them is that they only have one sweep date. So what does that mean? If I, Phil Resch, want to do monthly because I want to diversify my indexes over 12 months with 12 different buckets, 1 month is going into the Bloomberg or PIMCO or S&P. The other 12 are going into the fixed account until next year when then it goes into the sweep date. So if someone is doing monthly, I typically don't illustrate Allianz. If someone is doing annual, I will illustrate Allianz because of that very feature. They do have rate lock, so that is exclusive to Allianz. So if, for example's sake, you want to have a 10% return as the rate lock, it'll auto rate lock once it hits that number, even if it drops like a tank. I don't know if tanks drops, heavy right before the maturity date, you'll keep that 10%. So that is again a value proposition when it comes to an annual pay. You can secure that opportunity, and that's why they only have one sweep date because of the rate lock. So it's a give and take. Okay. Once again, strong illustrations doesn't mean they're always the best. Kind of like what I said with Eric, Allianz is a great story. A lot of people will illustrate them. I still think Symetra has a better product altogether from the accumulation standpoint. You want to talk big elephant in the room? We have National Life Group. Okay. NLG is the number one carrier in the industry for IULs. Why? They cornered the market in distribution with a lot of multi-level marketing companies. With PFA alone, they do $90 million plus in IUL business. They are a major driver for another company of people helping people and other organizations as well. People who like family as their first life. So stuff like that, you'll find that they will focus a lot on the NLG space. Okay. Doesn't mean they're the best, but I would say they have a lot of flexibility and opportunity. They also hit the gas in 2020 where everyone else pumped the brakes. So when everyone else said, well, we don't know what this COVID thing is going to do, National Life Group basically said, "Screw it, we're going to go for it," and they basically created non-med at higher levels to allow more people to buy their policies. So it offered an opportunity for people to illustrate them more, organizations to put more trust and faith in them, and that's why it increased their market share. And oh, by the way, they're the second oldest U.S. Based insurance company in the industry, right behind New York Life. They are the only carrier to offer living benefits inside the state of New York. They were grandfathered in. No one else has living benefits on their product suite inside of New York. They can also do premium finance strategies. I call it baby premium finance, like Kaizen or Stream, where less collateral. The Kaizen and Stream both take a cut of the compensation, but it offers premium finance for people who are the millionaire next door, not quite the normal premium finance. Uh, Very big in the foreign national space. So very popular in South Florida, Hispanic market, I-10 onlys. There's a big, strong Asian presence as well. So PFA is predominantly an Asian community, and we see a lot of business from that standpoint. Um, so they can also be stuffed into retirement plans, so set plans, Roths. You can do a Roth or a traditional IRA. They're the only carrier that you can go down to $100 a month. No $5,000 premium, but they can go down to $100 a month in just or contributions to a Roth or an IRA plan. And they have really cool business owner strategies in regards to twice a year. You can escort or bring a CPA to Las Vegas, where they will do continuing education credits, partnership to go deeper with CPAs. If you want to talk true value in partnering with CPAs, that's a great thing for them. Yes, you have to pay to get there. Yes, they have to pay to get there, but the idea is that you have the opportunity for them to learn more about our business, create a stronger branding opportunity, and build that trust, credibility, and rapport. Next up, Symetra. So I already kind of mentioned this is a real life example. 50-year-old, 20-year term, 3 million, submitted on Thursday, January 5th, and it got approved Monday morning, standard on tobacco. You think about this. So if people work with SBA loans, they actually have a collateral assignment division, so they can get a collateral assignment done in 24 hours. See you, Nana. So from that standpoint, they have a great story to get people, I guess you would say, the pig through the python. Is online application only for Symetra Swift term. You have to be appointed and in the state and with Symetra in that state to do their Swift term, because the fastest they got one paid is 18 minutes. So yes, it is very quick. I do not like their conversion options. It's only the current assumption UL, which is extremely expensive. So you can add a conversion rider to give you 7 years to convert to their IULs. So I would take advantage of that. It's like a 2% upcharge. Speaking of their IULs, they have the Ascent IUL, and that one is a top tier accumulation product, hands down. They are also the king of the microsites. They have a ton of microsites. So they have a lot of accumulation opportunities. They are work very well in premium finance, traditional premium finance. They've also been added to Kaizen, I believe, and their special exception with Stream. So you can use those in the baby premium finance world. High income, they work solely with the Nasdaq at this point because it's going to show better returns. The protection side, they have lifetime guarantees as well. They do have a permanent chronic illness rider on there. Dollar for dollar reduction up to 50% of the death benefit, up to 500 grand. So they do have a long-term care-esque rider built into their contract. And you can pay for another rider to give you 100%, but 500K is a lot anyway. So that'll give you 10 grand a month. It's a pretty good deal. North American, again, with the term, they're probably the most competitive. They're the next up, right behind Corebridge when it comes to pricing with living benefits. A more streamlined approach with the non-med. The Builder Plus 4 is their accumulation IUL. I would highly recommend if you're illustrating them, switch it from the 50/50 to 100% S&P because they still have it on that Fidelity account, which is garbage. They can show high income from that standpoint as well, and pretty solid targets from the producer standpoint. Yeah, Preeti.
There is one more smart builder IUL is also there, Phil. So what is that used for, and which one is equivalent to IUL? There is three forms in North American.
Yeah,
Builder
smart builder no one uses because it pays you like crap. That's just the way the
Yeah,
industry is, you know.
that's what the
Um,
small IUL it says. I tried it actually 2 days ago, so I was confused, and now I'm seeing, so I thought I'll ask that question.
Great question. Yeah, Smart Builder used for high liquidity opportunities. So it pays people like crap because it unlocks a high multiple of cash surrender value. Best way to put it. So if you think about it, so someone, and I'm not saying do this, but some people have hid money for FAFSA purposes inside of the Smart Builder and because they don't count life insurance towards FAFSA. So some people will do that. I think that's incredibly dishonest, but it's out there. So I focus on the two, the builder and the protection builder, because those are the true products that people are consistently using. Uh, the other one is very niche. Subash?
Yeah, I had personally recommended North America at one point of time, and in terms of allocation of fund, would you say I'm currently not having it in S&P, which I'm planning to switch to S&P, and I see the impacts of it. The growth has been very poor.
Garbage?
So
Yep.
garbage, yes, garbage would be the right word, right? I just was trying to be diplomatically correct. So, but
You're
anyway,
fine.
yeah, my point was, Phil. So, is S&P and Nasdaq combination also good, or would you recommend only put in S&P
If they have
because they?
NASDAQ, I would do NASDAQ too, because think of it this way, NASDAQ is a bit more aggressive than the S&P, but if you're in an account that has zero floor, you have upside potential that could be higher and no downside risk. So that's why I would say if you have the ability to do some NASDAQ, absolutely, because from that standpoint, it's only going to give you a potentially better return.
Sorry to stretch my question here, but would you say like 70-30, 70 with S&P, 530 with the Nasdaq, or 50-50, which is a safer bet?
Yeah, it's six one half dozen to another. I would say, depending on the caps that they give you,
Okay, okay,
that's what I would look at. So I haven't looked at it
okay,
lately.
okay. Thank you.
Yep. Eric?
Um, More like a comment that I'm looking for you to check, and I don't mind kind of doing it
You're welcome.
publicly. So I had a couple clients who were Primerica, and I told them they were going to get termed out. And I think I explained this to you. And I was able to use the protection builder to get them in a better position, get them something permanent. And I was able to custom build it. Cash value was not the focus. It was a straight death benefit for them because they were in their higher 60s. Would you have done something similar to, because they were like, hey, headset on getting covered. At that point, they realized cash value is not going to happen because they're 69 and 62. But would you have done maybe a different carrier in that perspective, or would this be the carrier that you'd probably do because of the customization of the protection, the ROP, all the good stuff all that stuff that's inside of North America? And I'm just looking for a little bit of feedback on that.
Yeah, no, you did it 100% correct. The only other carrier I would look at is Moo because they have a protection product as well that's around the S&P only. But what I've found is with North American, their dial a guarantee on the protection builder and the customizations, people like the minimum index credit at 2%. So there's no 0% column, it's a 2%.
That's what I was thinking.
Yeah, so yeah, I think you did it right. Living benefits are pretty solid from that standpoint. So yeah, I think you're on point with that. And that obviously leads to the value of that protection builder product. They have the dial guarantees. Folks, if you're doing any type of GULs, like stop. The reason why I say that is like this product, the QOL Value Plus, those products are going to be cheaper for the client, provide the same type of guarantees, and you make more. There is no reason to sell a GUL at this point because GULs, you are relying on the secondary guarantee. There's no cash growth. And if a client is late or misses a premium, that guarantee drops dramatically. With these, you have cash value buildup and growth. You have the opportunity for them to miss a premium. And guess what? You can still have a strong guarantee. It's leaps and bounds different than what it used to be. And too many people in this industry are focused so much on the accumulation IULs. I like the protection IULs more, to be honest.
Yep, 100%.
So yeah,
Thanks, Phil.
no problem. So strong carrier, strong value proposition from that standpoint. Truly love, what North American has from the protection side. And they have a really unique feature too. So say you want to call it quits, like most of the time, whole life policies, they have a reduced paid up. You can do that with both the builder and the protection products. So if you want to call it quits, you just want a death benefit guaranteed, they can calculate that for you. So they have options that a lot of carriers don't have. They're an ESOP based company as opposed to a mutual company or a stock company. So it's very unique, but a great story nonetheless. Great partnership too. So that's kind of it. The main carriers, like I said, there's tons of carriers out there. You don't need to learn them all. So what I usually tell people is, one, two, three, four to start, five maybe, is a great way to get moving. On the annuity side, because some people ask, well, what do you do with annuities? That's a toss up. I'm going to be honest. We have calculators or ways to do income annuities. That's why you guys need to come to the event in Chicago. See what I did there? NASA will talk about their accumulation annuity. And then we'll also have, with income, I run Annuities Genius, a great program. If you do a lot of annuities, a great program to use because it can give you an unbiased approach on annuities. But these are the carriers to just kind of focus on. It just hones in, and then you block out the noise. Someone comes up with a new X, Y, or Z. More than likely, like some people are like, "Oh, the Nationwide Nexus is a great IUL." I'm like, "Nah, not really." Symmetric can beat that hands down. So just because it's exclusive doesn't mean it's great. I'll put it that way. And that goes for people who have proprietary products too. So from that standpoint, I have 1 minute. So if anyone has any one question or so they want to ask, feel free to speak now or forever hold your peace. Eric, floor is yours.
Sorry, I bombarded your call. So on annuity side, I know you're like, hey, we can kind of build, it's kind of each to their own, but what's your perspective on bonuses versus accumulation, history, actual returns, things like that? Because I know a lot of companies, I know I'm not going to name any companies, but I know in the past, especially in 2020, a lot of companies were pushing massive bonuses. This kind of, and what I'm finding out in the back end is it was a big smokescreen. And
Yep.
so, what is your perspective on that? How do we navigate that? And just kind of how do you approach that?
Yeah, so what I found is in the bonus world, the issue at hand is that the people who really hit hard with bonuses, North American, Allianz, John Hancock, Lincoln, Pac Life. And so there's a reason why I'm very selective as to when, why, and how. Because when you look at the bonuses, Kyle Busch, great example. Anybody who's an avid whole lifer is going to just, or Primerica will throw up Kyle Busch and the IUL that Kyle Busch bought. Frankly, there were so many things wrong with that in the first place. They used Pac Life, which had the PDX product that had built-in multipliers. So for those who don't know what multipliers are, you get a higher par or cap rate, but you're going to pay 1% or 1.5% or whatever guaranteed on your cash value. So even in 0 years, you're now negative 1.5% on your cash growth because you have to pay a fee. So you had that product, plus he had flat extras because he was a race car driver, which means you have higher costs of insurance, and he was doing premium finance. So it was a giant catastrophe. But that's why, like, when I talk about things like this, Allianz, they were doing a lot of bonus programs. North American, after the iteration of the AG49, they snuck in and did a bonus program on their Fidelity account, giving a 3% bonus kicker, but you have a 1.25% guaranteed charge, a non-guaranteed bonus and a guaranteed charge. And oh, by the way, they can change that. So what happens is you find issues later on, they can't even sustain it. The Fidelity account, you need to have money go in the S&P in order to manage the Fidelity account to do what it's supposed to do, and that thing is a dog with fleas. No one uses it, but it brought in business. So that's the thing. There was even an article saying that North American brought a bazooka to a gunfight. and so and so they did a whole new reiteration of the AG49 revised because of that. And so now we're at more of an even playing field. And that's why, for me, I'm more the guy who just says keep it level, keep it easy, keep it S&P or NASDAQ or a mixture of the two. Because what you'll find is that that's why I like Columbus from their standpoint, plain vanilla. Less to explain, less to worry about, less triggers, simple and easy. Corebridge keeps their high cap rates on their S&P. NLG, not really. They're at like 7.75 or 8.25.
Right, right.
So, in Symmetra, they have a very clean product from a cost perspective. So if you're talking Phil's faves, it's Corebridge, Symmetra, and Columbus. Those are my top three. And but it doesn't mean I don't sell the other carriers. I got 18 1099s last year. So right fit for the right client.
Got it. Thank you for that.
Yep. I'm gonna butcher this. Vidika, did I say that right?
Yes. Hey.
Close enough.
So, how are you? I
I'm
have,
doing well.
thank you. Just couple question for F&G has a term policy?
It's built
No.
into their IUL. So
Okay.
it helps reduce the cost. If people want to do like high accumulation sales, you can bundle a term in, butchers the comps, and they're the lowest comps anyway. So it's like a double whammy. But yeah, they have it built in.
Okay. And other term policy who has with the Corebridge, Columbus,
Corebridge, NLG, Symetra, North American, those would be the ones I would focus on. Columbus pays like trash for their terms, so I've said it right to their wholesaler's face. I'm like, I don't sell your term because you don't pay us. And he's like, I wouldn't sell it either.
okay.
So yeah.
So all terms, this all company with the terms is convertible in just the 7 year. So under the 7 year, we need to convert.
Full conversion, entire duration of the contract, Corebridge, they have the best conversion privileges, hands down. NLG, full conversion privileges as well, but up to 65. So Corebridge will go up to 70 or the entire duration. NLG will go up to 65 or the entire duration. Symetra, if you add the rider on, you have 7 years. North American, you have 7 years.
Oh, North American has 7 year. And one more question for Allianz, Corebridge, and Columbus. From these three comparison, my client has just the minimum like target premium for IUL, and client is about 40 years, and for client ready for pay 20 years for grow and target premium. Which one best for low cost and more accumulation product?
I would do Columbus because you're going to have the opportunity. It's plain vanilla. Allianz will look better on paper. I'm not going to lie. But I think from the standpoint of when you say target funded,
Mhm.
Columbus has healthy targets, so it should reach your destination or your goal, but also give them solid living benefits, chronic, critical, and terminal,
Mhm.
and still provide a value to them. So they just have to, and I'll tell you this right now, because like I've worked with the Indian market for like 10 years now. Illustrations are what people, it's their gospel. So you have to kind of explain to them that these illustrations don't mean anything because they don't. So it's based on the performance, and all our illustrations show positive performance every single year. So, like with Columbus, they're not going to illustrate as good as Allianz, but I would put them up against any of these carriers right now, and it still provide a strong value proposition, especially if you're going to do target funding.
With the accumulation too, like grow.
Yep.
Okay.
Yep.
Thank you.
No problem. Tanisha?
Hey Phil, got a quick question.
Yep.
I don't know if it's quick or not, but came across a veteran that's trying to change over his Transamerica policy.
Mhm.
How do I get that information to you? It's like a $700,000 policy that he wants to
Convert. Yeah, it's
convert.
just a statement. So if he has the most recent statement, we can take it to trans and see exactly what they can convert it to. If he doesn't have that, the spec page, like policy number, product duration, etc., then we can go from there and see what conversion privileges are available. And for everybody here, that's a great conversation piece too, because there's carriers that have different conversion privileges all across, the board. So the beauty of being in this independent space, guess what? You can convert them and make money. So and help your client in the same token. So, but yeah, if you can get the spec page or the most recent statement, if it's term, they probably don't have statements, but if they
No, it
do,
is term.
yeah. So spec page, policy number, product name. You'll probably need date of birth and or social to send it over. You send it to me and we can send it to trans, and they'll tell us what's available
Okay. All right. Thank you.
anytime.
Hey, Phil, how are you?
Fabulous. Yourself? Good to see
Good,
you,
good.
my friend.
I'm talking first time, yeah. Hey, what about the premium financing? Where is the material I can read or something? Because I have some couple of clients, maybe.
So what I would say is let's set up a separate time for premium
Okay.
finance because there's a lot to it. There's a lot of people who do it wrong too. Like
Okay.
they'll try and say no premium at all and everything is bank finance. That is a big no-no. There's a lot of people who are getting in trouble for stuff like that.
Mm-hmm.
So what I'd say is let's set up a time next week. where we can kind of go through that. Maybe even for, like your team and stuff, we could do it like a premium finance training.
Yeah, yeah. I'm with the
So
Akshay. You know,
I
Akshay.
know. That's what I say. Like, just talk to them and see,
Okay.
what type of
Maybe I will tell
thing
him.
we could do.
Thank
Yep,
you.
yep. No problem.
Nice talking to you.
Always a pleasure. All right, guys. So this will be up on the YouTube channel too. So anyone who wants to take a gander at this goose, it will be available. Again, as always, truly appreciate the time. So next week, Tuesday at 4 o'clock Central, we do our health training. So if you want to get in on health, I have a desire to get in on health, shoot me a note, phil@valorfs.com, and we can get you in on that. And then same bat channel, we're going to do life insurance next week. And again, for those, please register for the Chicago event, the 29th and the 30th. Love to see you guys there, all right?
Well, you said
Thank you.
Tuesday, right, for the healthcare?
You are correct. Tuesday at 4 o'clock
Tuesday at
Central.
4 Central. Okay.
All right, guys.
Thanks, Phil.
Appreciate the
Thanks, Phil.
time. Have a great rest of your day. See ya.
Bye-bye.
Thanks, Phil.